Welcome back to my financial literacy corner, everyone. So today I want to talk about how a revised Parity Act could exempt everyday regulated stablecoin payments from capital gains, aligning them with cash-like transactions to the U.S. code. So listen to this. Under a new draft of the Digital Asset Parity Act in Washington, gains on everyday payments made with regular dollar-pegged stablecoins could be ignored for tax purposes. A shift that would make routine USDC and USDT, I'm going to slide in RLUSD in there as well, spending effectively tax-free for many US users if enacted. The bipartisan proposal led by Representatives Stephen Horsford and Max Miller in the House is being circulated as a discussion draft that rewrites how the tax code treats digital assets and payment tokens. This is good for us. The Internal Revenue Service classifies stablecoins as digital assets taxed as property, meaning that every sale, exchange, or use of USDC or USDT is treated as a potential capital gains or loss event. Tax firms note that converting crypto into USDC, swapping one stablecoin for another, or using stablecoin to buy any goods all trigger reportable transactions, even if the price stays close to $1. So the Parity Act stablecoin carve out. According to a summary of the Parity Act drafted report by CryptoSlate, the bill would create a carve out for regulated payment stablecoins so that sellers recognize no gains or loss on qualifying transactions as long as the token trades within a 99 to a $1.01 band to meet strict issuance standards. In that framework, the taxpayer's basis deemed to be $1 per unit in minor fluctuations within the band are simply ignored for day-to-day payments. A separate write-up of Reinforced Parity Act explains that instead of a flat dollar per limit transaction, the new draft focuses on whether a taxpayer cost basis falls below the 99% of the stablecoin redemption value, effectively enabling capital gains calculations for most small consumer payments in regulated coins. Only USD peg stablecoins issued by authorized entities and keeping their peg within 1% for at least 95% of trading days over the prior 12 months will qualify. That's why I slid in ROUSD. Tying the tax benefit directly to regulatory status and price stability. At the same time, the bill would extend the traditional wash sale rules to digital assets like Bitcoin and other actively traded tokens, closing a long-standing loophole that allowed aggressive tax loss harvesting in volatile crypto markets. For now, however, IRS guidance continues to treat every USDC or USDT disposal as taxable, and any relief for stablecoin users will depend on whether Congress can push the Parity Act from draft form into law and amid broader debates over U.S. crypto regulation and dollar-backed stablecoins. So in the end, if this does pass, in which I'm more than likely that it will because you know how they are about their money, your everyday uses with your USDC, USDT, and even your RLUSD will not be a taxable event. Now, mind you, this isn't financial advice. This course is financial literacy, so that way you know exactly what is going on in the financial sector, and so that way you can make the proper choices and decisions for yourself when it does come to your finances. So, thank you once again for coming by. Have a good day.